Good afternoon, everyone, and welcome to today's event. To begin our program, please welcome Suffolk University Professor of Finance, Shahriar Khaksari.
Good afternoon. It's my pleasure to welcome all of you to this timely and exciting event. I'm very happy to be with all of you this afternoon, even though virtually, but think about it, you don't have to wear masks. Today, I'm joined by Suffolk University MSF alumnus and one of my former STAR student, Dave Smith. David will speak for about 25 minutes, and then he will answer our questions. If you have a question, please write it in the chat feature anytime during the webinar. I will do my best to get all of your questions in the time allotted. Now, it's my pleasure to introduce David Smith.
Thank you,
David
Shahriar.
is the Managing Director and Chief Investment Officer at Rockland Trust. He oversees and manages the investment management group, is involved in performing research and setting investment policy, as well as managing client portfolio. Prior to joining Rockland Trust, David was a founding partner, senior vice president, and senior portfolio manager at Mellon Growth Advisors. He's a chartered financial analyst and a member of the CFA Institute. Beyond his tremendous professional accomplishments, David has made significant contributions to graduate programs in finance since his graduation. He's a member of MSF Advisory Board, and he's on the board of the student-run funds. Please welcome David Smith.
Thank you, Shahriar. Appreciate the introduction. In order to kind of make advantage of everybody's time, I'm going to move right into the slide deck and try to move through these quickly. This is a slide deck that we put together to sort of generate ideas, give everybody a little bit of context about what's happening, and generate hopefully some good questions that we'd be happy to answer at the back end of the presentation. So let me jump right into it. Obviously, in talking about the stock market, the economy, even the bond market today, the beginning of the conversation simply has to be what's going on with the pandemic. A year ago, coronavirus wasn't even in our language. Today, we listen to it, talk about it on a daily basis. I imagine it impacts every person on this meeting in various ways throughout every single day. The data that I'm showing you in all these slides is as of 12/31/2020, unless otherwise stated. And so this particular chart actually is a little stale already. As you may have seen, the data on the COVID daily caseload has been creeping up of late. A lot of theories as to why that is, depending mostly on holiday activity and people maybe not following the required or the suggested protocol around getting together at the holidays. And so we've seen caseloads that have been in the 200,000 or 300,000, almost 300,000 per day up until very recently. We're beginning to see that caseload tail off. The other thing that's happening, and it's happening around the country, but also in pockets where it's problematic, is we're having hospitals fill up and reach capacity. And that's obviously where the real problems arise. Hopefully, the slowing in the caseloads will result in slowing hospitalizations, and we'll continue to see positive trends on the medical front, where treating individuals who come down with COVID has become more beneficial, and the outcome of patients has improved substantially as we've moved through time and gotten more and more knowledgeable about COVID-19 and how to treat it, and also moved along on the medical front with regard to treatments for it. Clearly, when you think about the outlook going forward, you also have to think about what's going to happen with COVID. And we have some obviously very good news that we received in the fourth quarter regarding vaccinations and inoculation. We're in the process of rolling that out, although some would argue in a bumpy fashion. Hopefully the new administration will give clearer guidance to the states, and the states will take that guidance and implement it very rapidly so we can get a greater percentage of the population inoculated as quickly as possible. But clearly there's a gap between today and to a time when we get back to more normal. And that gap is a little scary to think about. Obviously, it's going to be some economic hardship as we continue to progress through the winter. Cold weather, being locked inside, has resulted in caseloads rising. We're seeing incremental changes in the protocol on how to deal with this. More lockdowns are happening in certain parts of the country. And all of that has economic implications that we need to take into account. So there's got to be a bridging of the gap, if you will, between today, where we're struggling with this, and the future, whenever that is, that we have enough people inoculated or have some protection against the disease because they've actually dealt with it and recovered from it, and where we are right now. So clearly the government's doing everything they can to stimulate the economy, both through monetary and fiscal policy, and we'll see the implications of that as we progress through this deck a little bit. This slide is looking at the side of the house that is the fiscal side. You can see, if you look at the slide here on the bottom right-hand side, that we now have cumulative debt as a percentage of GDP that has reaching levels that we haven't reached since World War II. And the implications of this are real. We don't know for sure exactly what the outcome will be down the road, but at some point you would imagine that we have to begin to pare that back. Clearly right now, I've used the analogy on many occasions that the economy is almost like a sick patient, and the government is putting all the medicine they possibly can at treating that patient. But if you think about medicine, sometimes you can overdo it, and sometimes also there's implications down the road, and that's exactly how I see both the fiscal and the monetary policy implications that we have from the activities that we're taking today. At some point, we've got to pay this back, and there's no such thing as a free lunch. The projection is this number will continue to grow, and it'll become an even larger percentage of GDP than it was in World War II. It's a fascinating statistic. When you look at what's happened in the economy, you can see that we had a substantial drop-off due to the activities that we were required to take to try to get control of the pandemic. That happened in the first quarter, and then we had a subsequent snapback in the back half of the year. Our expectation for fourth quarter is we will have a continued recovery, although clearly not getting us back to the trend line. So it takes a lot of positive economic momentum to drive the economy back to levels that we had prior to the pandemic rearing its ugly head. Here we see the consumer balance sheets. One of the fascinating things about the activities that the government has taken to try to stimulate the economy is it's produced a widening wealth gap. If you look at the chart on the bottom right-hand side, you'll see household net worth is at an all-time high, which is remarkable to think about in the throes of a pandemic. But the activities that the government has taken have actually stimulated asset prices. If you think about what's happening, single-family homes, both primary and secondary, particularly in nicer parts of the country where they're highly valued, have appreciated substantially. Inventories are incredibly low. Securities are doing incredibly well. The stock market is at all-time highs or darn close to it. And even bonds have rallied in price because interest rates have been cut, causing the price of bonds to rise. And the quantitative easing activity is also causing bond prices to inflate. All of these things are affecting assets that are held by the top half of the economic spectrum in our country, broadening out and widening the wealth gap that we've had in our country for years, and it continues to grow and build. So this particular pandemic is making that worse. Here we see unemployment rate, a spike in unemployment that reached 14.7% back in April. I remember the Great Recession and talking to folks and making a prognostication that we thought that the unemployment rate would actually rise to 10%, which it did just breach back in that period of time and back in the Great Recession period. You can see that we got to 14.7%, an unprecedented level of unemployment. It's come back in to the point now we're at 6.7%. Many argue that that number is artificially low because a large number of individuals are no longer looking for work, and so they're not included in the statistic here. but clearly there's been a very substantial recovery in the job scene. The question becomes what happens as we progress through the winter here? As more and more restaurants have to close because they can't serve patrons outside, particularly up in the northern part of our country, as more businesses struggle with outbreaks in COVID-19, do we see a scenario where this number reverses course again and starts to trend back up? Time will tell on that one for sure. This slide here is a prop for education. What this is showing you on the left-hand side is what happens to unemployment for varying levels of education activity. And you can see that for folks who have no high school or less education, the unemployment rate is always much higher than those who are well educated. But particularly in times of challenge, those numbers spike. And that's not surprising given that we live in a society that's driven by a service economy today, where skills, intellectual skills are valued. And you can see the implications. So folks who are on the bottom here in that bottom chart are folks who have a college or higher, and you can see the unemployment rate for those individuals has actually remained relatively low and didn't spike up too much when we had the real run up. The other thing is the implications of that on compensation on the right-hand side. Obviously those folks who are employed and in high-skilled jobs receive more compensation, and that's a real benefit down the road. So that's my plug for Suffolk University and the education system across the country. Get your MSF if you don't have one already. The next slide is just looking at some information that we've had to look at more recently. The economic data that we typically get comes with a lagged time period, and usually that's not too problematic. In an environment that you're dealing with a pandemic, you really want more current information. So we've gotten used to looking at information that flows with a higher degree of frequency than typical economic data. In this case, we're calling it high frequency economic data. And it includes things like single purchase, mortgage home applications. We're looking at hotel occupancy rates, folks who are logging in to travel websites to try to get a sense of, is the economy turning in real time? And you can see the trends in most of this data has been up and to the right from a bottoming that happened in that March-April timeframe, but still, again, not recovered to 100% of where the data were beginning 2020 before the pandemic really began in earnest. And so we've got room to improve, particularly in those areas that are sensitive to what we're dealing with. Hotel occupancy is a great example of that. We've recovered some from the bottom, but still off substantially, which has real economic implications to the financial models of the hotel industry. This slide here is a slide I put together because I'm asked the question all the time about the election. Clearly, leading up to the election, it was very, very front of mind. The point to take away from this slide is that regardless of your political persuasion, it's important to note that over most periods of time in most forms of government, meaning 100% Republican, 100% Democrat, or a mixed, House and presidential structure, the markets do well. And they do well in most periods of time. And the economy also tends to do well. So I've been asked a lot about the leading up to the election. How do you feel about the potential outcome of this versus that? And we said, well, you have to understand the construct of Congress at the same time. And then as that became clear, and we had the second election in Georgia around the construct of the Senate, and the outcome was a little bit of a surprise to many, that now we've got a government that skews to the blue. What are the implications of that? And for me, it's sort of dependent on the particular administration, the policies of that administration at any given point in time. But the long and short of it is, over time, the market tends to shrug all this stuff off, and it tends to do well regardless of the construct of our government at any given point in time. So it should be fine. So let's jump into the stock market a little bit. I have to say this slide is absolutely shocking to me to look at what happened to the stock market in calendar 2020. People were asking me in that February-March timeframe, how long do you think before we recover the price points from the beginning of the pandemic sell-off? And I was telling people that my belief was it was probably going to be measured at least in months, if not years, before we recovered. And here we are. Before the end of the summer, we actually recovered those highs and subsequently proceeded to go even higher, finishing the year with an 18.36% total return. an absolutely remarkable recovery, obviously driven off of the government's activities, at least in part, both fiscal and monetary stimulus put in place in high doses, as well as the great news that we got in the fall regarding vaccination. And I have to say, the medical advances that were made are absolutely miraculous. To think about the fact that a year ago, COVID-19 really wasn't even on our radar screen, and here we are 12 months later, actually giving folks vaccination shots today is really remarkable and a real so comforting thing from our scientific perspective. One of the phenomena that's happened over the last bunch of years is the widening out of growth versus value. This has been a really amazing period of time where value has produced returns of 21% per year over the trailing 5 years, while value stocks are only up 10% per year. So growth is outperformed by 11% per annum. The cumulative returns are magnificent. If you see on the slide, the difference in the total return, the cumulative returns going back 5 years of growth versus value, the question becomes, how much longer does this persist? And we know through time that these anomalies do come together occasionally, but generally speaking, mean reversion happens. The question is always when and what's the catalyst? As we look at 2020, the other thing that's very real about 2020, it was another year of growth stocks winning. Some of the data points here on this particular chart are really interesting. If you look at, for example, in the middle chart on the top, you can see stocks that had a price to earnings multiple in the 30s or higher were the strongest performing stocks in the S&P 500, producing returns of well north of 30%. Whereas relatively inexpensive stocks with price to earnings multiples of less than 13.7 actually produced a negative return. If you look at the bottom left-hand side chart, you can see big cap stocks, primarily the FANG plus Microsoft complex, produced incredibly good returns, again, the best by a bunch. And smaller cap stocks in the S&P 500 were barely positive for the year in total return basis, which includes the dividend ratio. The bottom right-hand side, the dividend yield, if you look at that chart, you'll see that stocks with dividend yields north of 3% were actually negative for the year, whereas stocks with a 0 to 0.6 were the strongest performing with returns well up into the 30s. So last year was a year where big, expensive, rapidly growing stocks dominated by a very large margin. The other thing that was interesting about last year is if you break it into three components, the first part of the year where we were kind of behaving in a more normal and really the trends that had been in place for the last bunch of years continued until February 19th. And then we had the February 20th through March 23rd sell-off, very precipitous drop, very, very scary times. We're seeing very unusual trading patterns, and then the subsequent recovery. And what's interesting about these three periods is they were all led essentially by the same groups. Generally speaking, if you think about periods of time in the past when we had substantial drop-offs, the group that was the winner in the up market was the biggest loser in the down market. Use, for example, the dot-com bubble bursting back in the late 90s. Tech was what drove it up, and tech was what got hurt the most in the downdraft. Here, what we're seeing is technology, communication services, and consumer discretionary, all of which have technology-oriented stocks that are the significant positions in those components or sectors of the economy, were the best performers in the top half of the performance group in the first period. They were in the top half in the second period, and all except communications were in the top half of the third period. And if you think about what happened here, we had the scenario whereby we had these stocks that are benefiting from the longer term trends. They were sort of disruptors, if you will, and they actually benefited from the stay-at-home mandate that we were required to take to kind of get control of the pandemic. So you see companies like, obviously technology companies like Microsoft, which are in the tech space. In communication services, we have Google's parent Alphabet and other companies that are technology-oriented, like Facebook is in there. And then you have, in the discretionary space, you have your Amazons and your Netflixes driving those companies to do better in all three scenarios. It's usually a very unusual period of time, and again, reinforces the point that the FANG complex, Facebook, Apple, Amazon, Netflix, Google, and including Microsoft, were really substantial outperformers in all three periods of time. And the rising tide didn't lift all boats. This is a snapshot of sector performance for the 11 sectors of the S&P 500 last year. And again, you can see that we've had consumer discretionary, the consumer services, communication services, and technology were the big winners. Materials also did reasonably well. But look at energy, a very substantially negative number last year. And you may remember back in that April timeframe into the early parts of the summer, where energy prices traded down and at one point were negative for a period of time. Obviously, energy companies aren't going to do very well when commodities are trading with a negative sign in front of them. The good news is there was a recovery to some extent in the fourth quarter in the price of the commodities, and the stocks have recovered a fair amount as well, but produced for the full year a very substantial negative return based on a very interesting time in that particular area of the market. Another thing that happened in 2020 in the stock market is looking at the concentration of the top 5 stocks in the S&P 500 reached an all-time high going back to the 1980s. We actually peaked out at 22.2%. So 5 stocks made up almost a quarter of the S&P 500, meaning the other 495 were equivalent to the remaining 75%. That's a remarkable statistic to think about. And it shows again how the market has appreciated the disruptive stocks and given them massive valuations on top of very strong fundamentals, both earnings and revenue. I'm asked quite a bit about market valuations and where we think things are going forward. You know, our approach to investing is to create strategic asset allocations and rebalance to them. So we don't make predictions on the stock market, but obviously we have a perspective on it. And one of the ways that we look at the stock market is to look at valuations. What I'm showing you on this particular slide is the price to earnings multiple of the S&P 500 on a forward 12 months estimated earnings. And you see over the long period of time, the average is 16.4. And then we have a 1 standard deviation band around the 16.4. And generally speaking, if you're inside that band, one could make an argument that stocks are fairly valued. You'll notice that at the end of 2020, we broke through that 1 standard deviation range. And so in theory, you would suggest that, boy, this might be a time that you would expect to see a substantial sell-off. In fact, if you look, the only other time on this particular chart where we broke through that top range was the time period I was describing a minute ago, the late 90s and early 2000s, when the dot-com bubble burst. But this particular time, I'm not as uncomfortable as I was back then. And let me explain a little bit about why. First is I do believe that the earnings estimates for the S&P 500 are very conservative. We are in the middle of a pandemic where it's very cloudy. It's very difficult to determine what the future economic outlook is going to be, and therefore very, very difficult for analysts and even the management teams of companies to give clear guidance about what the earnings expectations should be. So I believe as a result, the investment community is being relatively conservative. We're in earnings season now. We're off to a great start where earnings are exceeding the expectations even for the current quarter. And guidance seems to be pretty positive too. So my expectation is that the earnings estimates on the forward earnings will look a little bit better as we proceed through earnings season and then through the rest of the year. The second thing is when you look at the price to earnings multiple and flip it around, the way to think about it is an earnings yield. And an earnings yield should be, you would argue, compared to other yields in the marketplace, particularly bond yields. So when the 10-year treasury is trading at about 1%, that would imply that the earnings yield should be relatively low, meaning that the price to earnings multiple might be okay if it's a little above the long-term average range. Now, you could make an argument that the 10-year treasury security interest rate is artificially low because of the actions being taken by the Federal Reserve. So that particular argument is one you could have a strong debate about. But clearly with low interest rates, a higher PE multiple is probably better or more acceptable than it were, for example, if it were a high interest rate environment. The final thing I'll say is that remember the concentration I pointed to a minute ago, where the top 5 stocks are well north of 20%. of the S&P 500. Those top 5 stocks also happen to be very highly valued companies. So if you strip them out and look at the valuation of the price to earnings multiple of the remaining 495, it actually drops down back into the range here. So the massive amount of money that are in those top 5 names that are highly valued companies is distorting the valuation a little bit. So for those 3 reasons, we're not as uncomfortable with valuations today as we would be if we didn't have those anomalies exist. Here's a snapshot of the expectation for the S&P 500 earnings going forward. You can see a very substantial ramp up in the expectations, obviously wrapping up 2020 and then seeing 2021's earnings estimate today, even with the conservative nature of what I described earlier, exceeding that which we received in 2019, and 2022 is expected to be even higher than that. That's great news. And it's important to remember that you need to be in the stock market because it really is an amazing way to compound and create wealth for your clients and yourself. Here's a chart going back 30 years, and certainly there have been some dips along the way, but the trend over long periods of time is up and to the right, which is why you need to be exposed to stocks and you need to keep them as part of your portfolio in almost every circumstance. Now let's compare the United States stock market, the S&P 500, relative to a variety of other potential investments. So what I'm showing you here is a list of stack ranking returns, best performer on the left, worst performer on the right. And these are various asset classes that one could include in a diversified portfolio of investments. The blue bar is the S&P 500. And you can see that last year it was the 3rd best performer, only having a couple of things, precious metals, outperform. If you go to a 3-year return, you'll see that the S&P 500 switches from 3rd best to the best performing asset class over that period of time by a substantial spread. On a 5-year data point, you see the same trend. And even over 10 years, you see the S&P 500 is by far the best performing asset class on the planet. And so this brings into question for anybody that believes in modern portfolio theory and invests that way, why am I doing that? And it's an important question because clients want to understand this. So this is the same sort of information. This is just the equity component of the list that I just showed. This is what we call our heat chart. And all we're doing here is stack ranking from top to bottom, the best performer to the worst performer. And each color represents an asset class. Dark blue is the large cap US as represented by the S&P 500. And you can see that in the decade that ended in 2020, the S&P 500 was in the top half of the competitive universe from an asset class, equity asset class perspective, in almost every year, and was at the top a couple of years. And so for the entire decade, on the bar second from the right, it was the best performing asset class. And if you go to the far right, you'll see it also had the 2nd lowest volatility. So on a risk-adjusted return, the best performing asset class with the 2nd lowest volatility, again, if you use just this period of time, any optimization strategy would tell you just own large cap stocks and don't own the rest of the stuff. But one need only look at the previous decade to recognize that these things don't persist forever. So what I'm showing you here is the decade that ended in 2009. And you can see here that that same dark blue box was at the bottom of the chart most of the time. And in fact, for that entire decade was the worst performing asset class. So how long the large cap stocks will continue to outperform the rest of the types of diversifying equity strategies you may include in portfolios is the billion-dollar question. But it's been a persistence for a while now, and it's certainly been something that's been challenging for us to explain to clients, but we remain committed to being diversified, knowing that over time, mean reversion does happen, and we will get to a point where it no longer is leading the roost, so to speak. I'm going to shift over very quickly here to bonds and fixed income. What I'm showing you on this particular slide is yield curves, each of which is a particular point in time. The light blue line at the bottom is our current interest rate curve. And you'll notice a couple of things about it. First is that interest rates in absolute levels are incredibly low. The 30-year Treasury security on January 4th was yielding just north of 1.5%. 10-year is below 1% at that point in time. And of course, on the short end of the curve, rates are very close to 0. What's interesting about our current interest rate environment is if you think about the Federal Reserve's target of trying to reach 2% inflation, If they're successful at that and you're buying a 30-year treasury today, you've locked in a negative 0.5 real return for 30 years. So it's a really fascinating time to think about real returns and the implications of fixed income and rates at where they are today. If you look at the green line, that was the interest rate curve a year ago, and you'll notice that it was reasonably flat. The short end of the curve was much higher than it is today, and the difference between the short end and the long end was pretty narrow. In fact, in calendar year 2019, we had a period of time where the interest rate curve was inverted, meaning short-term interest rates were higher than long-term interest rates, which sometimes is a predictor of recession. Now, it's not a perfect predictor. There are times when it does that and we don't get a recession. Obviously, we did get a recession this time. I'm not so sure the bond market got it right, because I don't know that the bond market saw what was happening with the pandemic and the implications of that. But clearly, this is a period of time where that rule worked. The question is there was correlation there, but was there causation? I don't know. I don't know the answer to that. Time will tell. And then the other two are just looking back longer term. The reddish line was 5 years ago, and the gold line I would describe as a more normal interest rate curve where there's a pretty wide spread between short and long. That was a decade ago in 2011, where interest rates in the short end were still very close to zero, but we had a more normally shaped curve, so you were getting as much as 4.5% on a 30-year treasury back a decade ago. So here we are looking at Fed funds rates, and we go back in this chart to more than a decade now, a couple decades, and you can see that we've had a few periods of time where the Federal Reserve has taken an unprecedented step of driving short-term interest rates very close to zero. They started more recently in 2015 to ramp up, and thankfully they did, because then they had some ammunition to use in this recession that we just went through. They subsequently, once this information began to kind of cut rates, and then once we got into the thick of the pandemic, they didn't do their typical step downs. They immediately cut to zero. And what this is on the chart is telling you on the right-hand side is that the blue dots and the brown dots are right on top of one another. So what this means is the Federal Reserve is telling us as market participants that their expectations that interest rates will remain very low for a very long period of time. And the brown is indicating that the market believes them. Historically, there have been times when the Federal Reserve is giving some guidance, the market's not buying it. In this particular period of time, the market is essentially saying, based on futures contracts, that we think that what they're telling us is likely to be true, and interest rates are going to be low for long. And we'll see how this plays out. Obviously, they have the discretion to change their opinion and perspective as we move through time and data changes, but for now, that's the expectation. And this chart is showing you that we're not alone. These are the major central banks around the planet on the left-hand side. That would include the Bank of Japan, the European Central Bank, and the Bank of England, all of which have moved rates now down to zero, and all of which in some form or fashion are also practicing quantitative easing to drive long-term interest rates down as well. On the left-hand side is the developed country yields around the planet as of 12/31. You'll notice that all of them are below 1%, and we still have some that are trading in negative interest rates. When I was a student of Shahriar's back in the 90s, there was no discussion about negative interest rates. I went back and looked at the Fabozzi book, and it says nothing about how to compound a negative interest rate. So these are unprecedented times. But there are opportunities to get yield in the planet. You just have to sort of go out on the risk curve. You can see that if you want to pick up a 12% yield, you can load up on Turkish bonds. I'm not so sure that's a prudent investment, but there are opportunities even today in this crazy low interest rate environment if you want to take the risk. Another thing that happened in this calendar year was a really anomalistic market in the municipal bonds. So much so that we actually took the opportunity to put municipal bonds in some of our tax-exempt portfolios because we had a massive spike up in yields on what has historically been a relatively risk-free or low-risk investment in high-grade municipal securities. The market is not very liquid in municipal bond trading still to this day. And in the stress time that we had in that first quarter, we had some really crazy dips down in price and spikes in yields that we took advantage of. Market got efficient with the help of the Federal Reserve and moved those rates back down to more normal levels. already have had nice price appreciation in some of those bonds that we purchased. But it was a really unusual time where the market kind of froze up temporarily. And for those people who are sort of a little bit flight of foot, you could take advantage of that. The final slide I'm going to run through here is just a long-term picture of interest rates going back into the 50s. And you can see here that the market interest rates peaked in 1981 with a yield that was very, very high in the 13.8% range. And we've been in a long secular bull market in the bond market where, as I mentioned earlier, finished the year at slightly below 1%. We're slightly above 1% on the 10-year Treasury today. And the question is obviously, where do we go from here? Do we get back to a more normal environment for the Treasury security, or do we stay at these low levels for a long period of time? And it's very, very difficult to predict that, other than to think about the real return aspects of bond investing, which I described earlier. Meaning, again, if we get the Fed's target of 2% inflation, if the bond market doesn't produce a yield that's north of that, you would be getting ultimately negative real returns. And that's probably not something that bond investors are going to tolerate forever and ever. Just some disclosures here. I'll just finish up with some comments just to kind of conclude here and then take questions. As we think about going forward here, I think the way that we're certainly viewing the world is, as goes COVID, so goes the economy and very likely the market. And one of the things that we're concerned about today is the news around mutations of coronavirus and what the implications of that might be to our ability to inoculate a large portion of society. There's a strain that's been found in South Africa, which seems to have mutated to the point where it's a little bit different and may or may not be able to be treated by the vaccination that we have discovered today. My understanding of the science is that the vaccination can be altered to address that, but it's obviously very, very new, and that's a scary phenomenon. But that's something that we're monitoring literally day by day and try to keep current on that. The other thing that's very real is the medicine that we're deploying, again, to treat the economy today. Massive amounts of monetary policy and fiscal policy stimulus has got to come with some implications down the road. The only saving grace is that we're not the only country on the planet that's doing both of those things. So on a comparative basis, I don't think we look any worse off than some other parts of the world. But at the end of the day, writing giant checks against the future and our children and grandchildren's future to finance this thing is an unfortunate reality and necessity to get us through this particular challenging period of time. And I hope that it's a relatively short period of time, and that the stimulus that's being discussed and hopefully voted on in the not too distant future is the last one that we have to do to get to a point where we can come out of this and get back to a more normal environment. So with that, I'll take a pause and I'll be happy to answer any questions that came up, Shahriar.
Thank you, David. March of last year, the COVID-19 pandemic was officially announced. As of today, more than 400,000 people are dead in the US alone and lost their lives to the pandemic. Many sectors of the economy, in particular hospitality-related business, has been hit extremely hard. National debt is ballooning, unemployment rate was double-digit, and as of today, it is very high. Even though vaccination for COVID-19 has started, there is no certainty about the end of this pandemic, as you just mentioned. Stock market initially reacted strongly to this news and dropped significantly. However, since then, all major indices have reached new highs. From 2016 to 2020, the stock market appreciated 57%. And during the first 2 months since the election, the stock market has appreciated even more than the first 2 months of Trump administration. In fact, you referred to that. Many people think that there is a disjoint between the economy and the stock market. What are your views on this issue?
Great question. I am concerned. I think the market is, as I mentioned earlier, from a valuation perspective, certainly it's hard to make an argument that it's cheap. If you strip out the big tech companies, it looks less expensive, but it's not cheap. It's hard to make a case that it's cheap. Mm-hmm. And you might make a case that it's priced for perfection. In other words, the market's forward-looking viewpoint at the moment is that this is going to end in the not too distant future. I mentioned a minute ago, mutations and variants and the implications of that. If we were to get a mutation that was no longer reacting well to our vaccinations, and we had to go back to the well and go through clinical trials again on a new vaccination for a new variant, I don't know that the market would continue to plod along consistently as it has. To me, I think that would be a surprise to the marketplace and a negative implication. So I do fear that we're kind of priced for perfection. I see pockets of the market that remind me a little bit of the late 90s, where the .com phenomenon was so real, and anything that went public that had .com just inflated crazily. Some areas of the market that are concerning today, clearly valuations of some of these big disruptors look stretched. They're high. It doesn't mean they can't stay high, but they're high by any sort of normal way of looking at things. I think the phenomenon of SPACs is really fascinating. It's a new thing. These are single purpose acquisition corporations. They call them blank check companies, where you give the company money and let them go find something to buy and hope it works out. I've never seen that type of speculation in that particular form in the past. And it seems like there's a lot of activity there, and it can't end well for all of them. So that's a concern. So there appear certainly some things that make you concerned about where we are and are we priced for perfection, to the point where if we have any disruptions, there could be a risk for a substantial sell-off. And that's natural. It comes with the territory.
Thank you. My next question related to taxes and regulation. During the tenure of the previous administration, corporate taxes were cut from 35% to 21%, and many regulations imposed on corporations were removed. Some argue that these measures reduced the cost of doing business and led to improvement in corporate earnings. The new administration has promised to raise taxes on US businesses to 28%, from 21 to 28%, and revive and impose regulations in many areas such as consumer protection, environmental issues like Keystone Pipeline, and others. What do you think the impact of these measures will be on corporate earnings and stock prices?
Yeah, well, clearly, I mean, the easiest thing to talk about is a change in tax rate, because if tax rates go higher, by definition, earnings will come down. It's the exact opposite of what happened when we cut them. We saw a substantial spike in profitability of companies on an after-tax basis because the tax rate was low. I do believe that the United States needs to be competitive with its tax rate. And the reason for the cut was we were at 35%, uncompetitive. And we had a scenario where many large national and regional and global companies were relocating out of the United States into tax jurisdictions that were more beneficial to their bottom line. And the good news is that seems to have slowed with the change of the tax law. And I hope that if we were to raise it, that it would not be increased so much that we'd have that phenomenon kick in again, because that's obviously not good for our country and our economy. To me, the other thing you need to think about going forward is the stimulus that we're going to put on. Is that enough to offset the implications of some of the negatives of the change in policy? Regulation, I think, is something that is okay in limited doses. I think you can both over-regulate and under-regulate. And I kind of think the regulatory environment, my perception of it is like a pendulum. We kind of go to over-regulating, and then we kind of get lax, and we get to under-regulating, and then we have a big problem, and then we over-regulate it. And so it would be ideal to have a little bit more borders, if you will, to keep the pendulum from swinging so much to the left and to the right. And not to be political, but it's not what I'm trying to do here, but just to eliminate the likelihood that you'll drop way out of either end of the continuum. So from my perspective, we'll see what happens. I do believe that the Biden administration's got the first 2 years, they've got just slim majority of control. Whether or not they're going to focus on trying to increase corporate taxes and in regulation, or focus on some other of the components of his platform that he's more focused on, we'll have to see. And clearly a shift in any, it could easily happen if we, God forbid, someone passes away or resigns or retires. We could have a shift in the construct of Congress pretty quickly here, even before the midterm. So a lot of questions about what he's going to focus on and what he can get done. between now and 2 years from now.
Thank you. U.S. national debt, as you showed in your charts and slides, have gone up significantly. In fact, it went up by $7 trillion under the Trump administration, reaching $27 trillion, and the highest, in fact, in the US history since World War II. This was partly related to the tax cut that we just discussed, and partly because of the pandemic and the stimulus package. Expectations are that national debt continue to soar under the new administration with a proposed stimulus package of close to $2 trillion, 1.9, and spending on major initiatives in the areas of renewable energy, environment, infrastructure. It's going to continue. At the same time, we are enjoying a historically low interest rate that in part makes the cost of borrowing by government more manageable. So what do you think are the impact of previous and expected increase in national debt on inflation and interest rate? And what should be the role of Fed in this process?
Yeah, well, first, as I mentioned earlier, I kind of view what we're doing as an unfortunate necessary medicine that we're taking, right? So this activity that we're taking is trying to keep the economy afloat until such time as it can get on its feet. I am very concerned about the long-term implications of that. And logic would tell you that if we continue to print, borrow more and more money, at some point the rest of the world will begin to look at the U.S. Treasury security and perceive it to have more risk, which they would then require a higher rate of return. The Federal Reserve obviously is doing everything they can through printing money and buying securities, both Treasury agency and other types of fixed income securities, to keep interest rates low. And so on one part of government is borrowing more money, the other part of government is doing everything they can to keep the interest rates low. But the Federal Reserve, they can't do that indefinitely. The markets has other participants that are thinking about things on a more traditional fundamental basis. And if we get to the point where they get concerned that the level of debt that we have in our country relative to our GDP is challenged and no longer sustainable, they would require a rate of return that's higher than that which they require today. And so at some point you would expect to see interest rates rise. The question around inflation is also very real. The printing of money in theory would tell you that there's more dollars chasing around the same level of goods. In theory, that would drive prices higher and you'd see inflation. The government statistics, at least the way that they count them, and you could argue that they don't count it, right? But the way that they count them, we aren't seeing any evidence of inflation in the system at all. In fact, the government is trying to see higher than their target inflation for a period of time so that we can get the economy going again and get on sort of to a pace that is sustainable going forward and ideally keep growing into the future. So it's really interesting that we don't see all that. I am concerned about it, as I mentioned, and I think that what we're having to do here is saddling our children and grandchildren with a liability that we are benefiting from today that is a necessary evil, if you will, of what's happening with this pandemic.
And follow up on that. Obviously, based on the analysis you presented, S&P has done a fantastic, has been a fantastic vehicle for investment. But now with this expectation about the higher inflation rate and higher interest rate, would you make any adjustment to the asset allocation of your portfolio or the investor's portfolio? Would you put more money into stocks versus bonds or alternative investment and so on?
Yeah, so as I mentioned earlier, we're strategic allocators, so we don't try to forecast what's going to happen in the stock market or the bond market. We use long-term historical returns, the variation, standard deviation of those returns, and the correlation coefficient of those things to construct portfolios. And we rebalance to our weightings. We periodically go out and look at those constructs and see if there are things that we can add. And I would tell you that that's what we're doing today. We're trying to find asset classes. The market, the financial services industry is a remarkable industry. We do some great work, a lot of innovation that's happening. So we're always scouring the universe for new investments, new asset classes that we can include in the portfolio that will help us reach our clients' objectives. And we're doing that with more earnest today than we have historically. And we're trying to find some things that have return streams that look different than the traditional asset classes, that maybe are not, as a result, not correlated highly, and ideally have a return expectation that's going to help us get our portfolios to meet long-term objectives. So an example of that, for example, today is that we've got exposure in our portfolios to a relatively new asset class. It's been around for a while in the hedge fund space, but catastrophe bonds is an example of that. So it's really taking a sleeve of reinsurance property casualty risk. If you think about the implications of that, there's absolutely no traditional economic exposure. It's got no credit risk in the context of economic credit. It does have exposure to a series, if you had a bad run of catastrophes, we would have some impact there, but the yield on the investment is pretty compelling and it's non-correlated. So we're trying to help our clients reach their objectives by looking at innovation and trying to include things in portfolios that will diversify risk as much as we can.
Thank you. You discussed very briefly about the performance of energy stocks and energy sector. What are your expectations about, from here on, moving forward?
Yeah, I mean, sort of when I think about the energy space, there's really two pieces of it, right? First is oil, which is a global commodity, and it really is driven by some parts of the world that are not free market capitalist systems, right? So, you think about OPEC and now OPEC Plus, which includes Russia and a few other countries. Globally, supply is controlled really by them. The marginal barrel it can be produced by Saudi Arabia relatively easily. What we're seeing here, however, is I think a rational reaction to the prices, and that you think about the exploration and production companies, the integrated companies have all announced substantial cutbacks in their drilling activity, which has resulted in a substantial drop off in rig counts. So we're seeing ultimately activity that you would expect to see in an environment where prices declined a lot, and that is they're drilling less, which ultimately results down the road in lower supply here domestically. That I think is good news, because I do believe that when OPEC Plus is looking at what they're doing from a supply standpoint, what they don't want to do is give up share to the United States. So the fact that we're reducing our supply through this reduced drilling activity, I think gives them some cover to keep controls on the drilling activity that they have in their countries. If you think about the implications of that, if you have reduced supply at a time, if we do get economic recovery here due to vaccinations, there could be a scenario where we have a substantial spike in the price of energy. And the scenario would be we get a real ramp up in economic activity at a time when supply is constrained. And you could see in a scenario like that where energy prices could spike up again and break through that $100 a barrel level that we've seen a couple of times in the past couple of decades. Obviously, that would be very, very good for energy stocks, broadly speaking. The other commodity you have to be focused on when thinking about energy is natural gas, and that's more of a domestic market. And today, we're way oversupplied there. But I think there's some regulatory changes coming from an environmental perspective that might control that a little bit more. And so there's even a scenario where you might see that commodity begin to behave a little better and get some benefit in the E&P space, especially here domestically. So we'll see. But it's been a very volatile area for sure.
We are getting there. One more question, if you don't mind, to
Sure.
answer this one. It's related to technology, the AI, big data, robotic, automation of workflow, and so-called fintech has created opportunities and threats for financial institutions and financial markets. What are your views on those, and where are we going from here?
Yeah, obviously had an impact already, and I think the impact is going to continue to be felt. So the way that we've evolved our business here is to try to increasingly add services to the client service. So we're in the wealth management business primarily. We do have an asset management component of what we do. But if you think about technology, broadly speaking, what technology does is do things that can be repetitive, that need to be accurate, and do them with great efficiency. And so when we think about our practice, we're using technology to drive efficiencies in the parts of our business that we used to think were value additive from a human being perspective, and letting the computer do that work. For example, rebalancing, right? Computer can do that very easily to a decimal point, where a human being takes a little bit longer and oftentimes can result in errors. And then think about, how do you add advice to the service you're offering so that you're really thinking about things that a computer can't understand. I use an example all the time about the family dynamic of the clients that we serve. A computer, at least for the foreseeable future, isn't going to be able to understand that a husband and wife come in as a client. They have a child who's married to a spouse that the wife doesn't like. And how are they going to handle that in their estate planning activities and in the care of their grandchildren or what have you? These things are much more dynamic, they're much more human, and I think it's going to be a long time, if not indefinite, that a computer will have a hard time understanding what we can adapt. It's an emotional intelligence that I think is going to be very, very challenging for a computer to emulate. And so for me, when I think about giving guidance to young people as they're starting out their careers in finance, I say to them, try to think about how to position yourself in an industry or parts of the financial services industry that are less impacted by technology, AI, things where there's no historical pattern, for example, like venture capital might be another area that's reasonably well protected, or where there's less information or less ubiquitousness in the assets like real estate. So I think you have to be thinking about that and thinking about how to take advantage of it in your business and continue to add value. But it's clear it's coming.
Yeah. I think that we can wrap it up if you getting close to the end of our session. I want to thank you, David, for sharing your insight on this very timely topic, and you did a tremendous job. I want to thank all of you for joining today's program and for supporting Suffolk University during this challenging time. This concludes the presentation. I hope you all stay safe and well. Thank you.
Thank you.